Hello and welcome to this week's Market Outlook. This is Jeff Bish, president of MarketGauge.com, filling in for Keith this week. Don't forget to subscribe to our YouTube channel if you're watching this on YouTube, and if you want to receive this weekly update via email, make sure you sign up at MarketGauge.com. If you're already there, you should see the sign up form in the upper right hand corner of this page. So I've got a full plate this week. I will go through a whole bunch of different information, and I'm going to start off just by saying I'm going to try and make this as balanced as I can be. I know a lot of the information is going to come across as if I am quite bearish, and the important thing to remember is you need to trade the price. So I'm going to start with the price, and the foundation of the price is that the SPYs, upper left-hand corner here, seem to have held, well, they did hold this week, the 50-day moving average, and actually closed on a relatively positive note by closing above the consolidation of the week, more or less. The other interesting turning point pattern would be that the diamonds, or the Dow, which was the most washed out over the last several weeks, had an inside day, and if you've been to any of our webinars, free webinars, you know what we do, you know how we like inside days as potential turning points, and the confirmation closing above it. So the Dow actually has an interesting reversal pattern at work here, although it's definitely pretty weak. That said, when you combine that with the fact that the IWMs didn't make a new low at the same time that the SPYs made a new low and have continued to move higher, actually close above the 10-day, and with a reversal pattern at the 50, seem to be moving up. And the Qs also broke out of the consolidation after testing the low end of the consolidation just a day or 2 days earlier. So if you're just looking at the price, it's been a pretty interesting week in terms of letting the market come down, consolidate, and now heading back up. And in each case, I could make the argument the Qs held support here. The SPYs are holding at their 50-day moving average, which is what this magenta line is, and it's positively sloped. The diamonds have support over here on the left, which I won't show right now because it'll mess up all my drawing placement. And the IWMs also holding at their 50-day moving average. And so all four indexes have shown some signs of turning up, and I don't want to take away from the fact that if you're just trading the price, you have to look at the pullback as having held and starting to bounce. Now, from a very basic level in terms of the technical analysis, and basic isn't bad, I love basic, IWMs have some pretty heavy lifting to do to get up and over this line here, this resistance level. The Qs, not really sure how much trouble they'll have taking out this high based on how strong they've been. And the Dow, if the Dow rallies, is going to be facing a negatively sloped 50-day moving average when it gets up there, and that historically, with any market action, first correction back up to a negatively sloped 50-day moving average is threatening, to say the least. And the SPYs are going to have some formidable resistance, just like the IWMs, from where they broke down from. So there's definitely some key resistance levels to look at from a very basic point of view, as I point out. Now, there are some good reasons to believe that we should bounce from here in terms of the underlying market breadth. So let me pull in a couple of market indicators here. All right, you may recognize this one from last week. This is the VIX with some Bollinger Bands around it, and my point last week was watch out for this trend. After taking out the low end of the Bollinger Band and coming in through the 20-period moving average here, if the trend continues higher, you want to watch out for increasing fear leading to decreasing prices. And essentially, we did get that. Market under pressure. and the VIX rose. But as the market stabilized and moved higher, we got a nice pullback in VIX. Now that's what you would expect in a market that is not afraid to go higher. If we didn't get a pullback in the VIX and the market moved higher, I'd be a little more concerned. So the VIX is doing what you'd expect it to do in an environment where the market's looking for a pop, and the VIX got to the top of a Bollinger Band, now back into it significantly. That's another little pattern to look for to suggest pop could last a couple days. Not necessarily a long-term indicator, but a short-term indicator that you might have kind of wrung out some of the fear in the on the downside. The other thing that is that points towards the possibility of a pop over the next couple days would be that the McClellan got to a low level and turned up. All right, not a catastrophic level, but this minus 300 level is a good level to look at as a pretty significant washout in terms of breadth. Now, it's not a major bottom level, but it is, when it turns back up, supportive of if the market continues to move higher and McClellan continues to be relatively positive, then again follow the price. Now, that said, we've got a really good example of how a similar situation just back in June identified that the market may have been a little washed out here. As McClellan moved up, so did the market, but it didn't mean the market was done going down completely. All right, so none of this current action here is suggesting we can't make a new attempt at new lows. It's only suggesting that if the momentum is going up, you did reach a level that is conducive to a market starting to bottom. Now the market needs to get its legs back and start running to the upside. For other reasons, this is just indicating a little flushed out, maybe we can turn back up. And the same analysis goes for the next chart that I'll show you, which is the 10-day rolling sum of advanced declines. Now it's a similar, let me see if I can find it here, giving you a preview of what's to come. Okay, here we go. So this is the 10-day sum, and interpretation very similar to the McClellan, which would be if you get down in this area, you're pretty washed out, and once you start to turn up, you can look for a small bounce. But we really don't turn to a bullish stance based on this indicator until you get above this red line here. However, from a washed out level up to here can lead or can indicate at least a small bounce, multi-day bounce. If it starts to get up and start climbing more significantly, that would give us more confidence that the bounce might turn into a more significant rally. But you do need to watch out for sell-offs when you're in this oversold area. All right, it's a dangerous area to be in, or I should say it's a fragile area. If the price action turns down, you want to watch out. If the price action continues to get constructive, you want to follow it. All right, so what does all this mean so far? What it means, if we just take a look at the SPYs, is we wanted to be really careful in here, which we were, especially from a swing trading perspective, lightened up on all our positions. And I actually had the most long exposure today than I've had since this break as a result of that. And so long as everything continues to move higher, then we can kind of follow it to the upside. But if it starts to turn lower, we want to be cautious quickly. I said this last week. I have other reasons to believe that this decline may be longer than just a couple weeks. I still feel that way, and in fact, I feel that if we turn lower, there's a few more things we want to take a look at that may indicate or give further evidence to another decline. Could be a significant decline. But before I do that, there's a couple of other positives in terms of market action that we'll want to keep our eye on. First one, OIH. If the market's going to rally, OIH looks pretty well positioned to have a good move. The reason I say that is because you can see it holding the 50, the magenta line, nice flagging action back to that level, and if it breaks out above this significant level here, or here, then we've really got some room to run a vacuum, longer term vacuum to the upside. So longer term, OIH, I'm watching that if the market gets strong. With the OIH, is not exactly where I want to see market leadership from, but it is an area where it has reacted well, and so I'll look for continued strength there. Also look for continued strength in IBB, which bounced nicely off the 50. Again, drugs leading the market, not necessarily the best leadership, but if there is place to go, drugs definitely look interesting. Another tangential but probably bullish indication for equities in general. The German equities are breaking out above pretty significant resistance here. You can see long term. So if we can get the European, or at least the German market rolling, should be supportive of a positive U.S. market as well. They're not necessarily hand in hand in terms of correlation, but equity markets doing well, that would be part of a bullish argument. Now, part of the bearish argument recently has been interest rates rising. I want to show you a chart on the TLTs. Let's start here, however. Really nice, sharp rally after several days of consolidation. And this really is more interesting if you consider the context of the bigger picture. So let me pull in a completely different view. And what we're going to look at is a daily, weekly, and monthly. You've seen this on Keith's charts. RSI measures and long-term moving averages. So I pointed this out, Keith pointed this out when the TLTs were here, which is the gray. The gray line here is the 200-week moving average. I admittedly said this looks like a pretty good place for it to hold, and that was up around 106 area. So this whole leg down here on the daily chart was completely through that level, and that actually could be a good reason to believe that we are in fact a little bit washed out on the TLTs. For one, if you look at the weekly RSI, we've got a nice divergence here. So here's where thought it might hold, in and around here around the 106, punches down really decisively through that level. RSI doesn't get as oversold here. Now it starts to bounce. That's when you start to think this could be a divergence. And on top of that, if we go to the the daily did get washed out down here, and so now it's turning up from a oversold level. Just reason to believe that the bounce could last. Now, I'm not looking to be a buyer down here. I think there is somewhat of a structural shift, turn in rates. So I'm not going to say interest rates are going back up to their historic lows of several months ago, but weekly divergence, daily washed out, and monthly holding on the 80-month moving average, which, as you can see in the past, isn't necessarily a pinpoint level, but it is a level that gets respected. It seems to be respecting it right now, and it's doing so at a pretty low level in terms of the RSI, indicating it's pretty stretched. So all these things combined on the TLTs indicate that maybe the TLTs are due for the bounce I thought was coming several handles ago. Could that be positive for stocks? It may or may not be, as long as the rally in TLTs isn't being fueled by fear for declining stocks. So if I were to end the video right there, I would think you'd be leaving the video with the context of looks pretty bullish in the short term as long as it doesn't turn lower. That would be a good and correct assumption. Let me show you the other side of the argument, and the other side of the argument really is what I want you to watch out for if the market turns lower. All right, so follow the price. If the price turns lower, sometimes when price turns lower, you want to be eager to buy the dip. Once again, I'm going to say this isn't a dip you want to buy unless you've got a really good price pattern that indicates, kind of like we have right now, that it may be time to bounce again. Let's start with a relationship that I talked about almost exactly a year ago. And that is the relationship between gold and the SPYs. Hold on. All right, some of you may recall this chart, and as I said, it was about a year ago when I brought this to this Outlook's attention, and that was that the SPYs were breaking out, and breaking out to what was looking like some significant highs. But what you see down at the bottom of this chart is the relationship. It's a ratio between gold and the SPYs. And to summarize, the lines, the vertical lines here, are every time the ratio goes, with the ratio being in red and a moving average of it in the kind of the light bluish. So whenever the ratio goes from one side of the moving average and stays on that side for a couple of weeks, you get a vertical line indicating that's when the cross occurred. So when the ratio is above the moving average, S&Ps tend to lag the performance of gold. In other words, you'd rather be in gold than in the S&Ps. When the ratio is below the moving average, then you'd rather be in S&Ps than gold. So I brought this to our attention with the breakout of the S&Ps, suggesting that both the S&Ps and gold weren't likely to be doing well, and that might be a negative for the S&Ps at the time. As it turns out, the momentum of the ratio never really got going, but it did stay in an environment of slightly negative for the S&Ps, and the S&Ps had what doesn't look like much of a sell-off, but you would have been happy to have missed it and stayed out of it until such time as the ratio turned in the other direction, which was right about here. And so since late 2012, the ratio has been firmly in the positive territory for SPY's point of view. So we've got a major outperformance. Both went in opposite directions, which is what this ratio would suggest. Gold sold off hard, SPYs rallied nicely, but as you can guess, I'm bringing this back to your attention because we're starting to flip the other way. Now, this is definitely early. Okay, I like to see the ratio over the moving average for a couple of weeks before I get too convinced that something might have changed. However, I've drawn in the trend line here. That's a closing basis trend line on a weekly chart on the SPYs. So not only are we down at the 50-day moving average, but we're near a significant closing trend line. So here starts the evidence of if the market starts to sell off and this ratio turns higher, then gold is going to be an interesting place to look long. SPYs are going to be an interesting place to look short or negative. So keep an eye. I'll be keeping an eye on this ratio. Things are lining up nicely in much the same way they have done in the past. And well, that's just one ancillary piece of information. And another way you might take advantage of weakness in the SPYs and strength in the gold. If you see that happening and you see it continuing, gold will probably continue, SPYs will probably continue in the direction that you're going in. All right, another chart we want to take a look at that I talked about last week. Two charts really, and that is the Qs have recovered, and they look like they're back in good shape, but the SMH has not. All right, so even though the rest of the market, or I should say the broader markets, have taken out their consolidation and started to move higher, SMHs remain handily broken down below their 50-day moving average right here, and not even back above their consolidation areas. So that is a sign of weakness. SMHs, if this market's going to continue to rally, you want to see the SMHs rally as well. Likewise, the XLFs. Now the XLFs are looking better than the SMHs, but I'd like to see the XLFs, which didn't follow the market higher today, move higher if this market in a general sense is going to continue to move higher. So keep an eye on those XLFs and the SMHs. Make sure that they move higher. Now I've got another interesting chart here that I stumbled on. It wasn't originally my idea, but I found it rather interesting. Now, before I explain this chart, let me preface it by saying, if you find a piece of information that is highly correlated with the market, and that correlation seems to go awry, it's a heads up. And that's really why I'm showing this to you. The purple line here, as you can see, is highly correlated. In other words, moves generally, these two lines generally move in the same direction over time. So when this relationship breaks down, you got to ask yourself the question, is this a problem? Now the blue line is the S&P, if you've been looking up top. And the purple line is what's called the currency harvest. And this is the relation. This is a measure of the carry trade. Now, the carry trade, in short, is when you borrow against one currency and buy another currency and make the interest rate spread differential. It's a strategy employed by with billions and billions, maybe even more, of dollars by hedge funds, in order to essentially, and it's been described as kind of the long-term buy and hold strategy for currency traders, and as a result, it often indicates or trades in line with the equities, the S&P, as you can see. So when this gets out of whack, and when I say out of whack, you can see the SPYs have continued higher, but the carry trade has gotten crushed. Right now, you can say what you want about the fact that the carry trade is affected by interest rates. Absolutely, it is. Interest rates have rallied. Absolutely, they have. However, that's happened in the past. It certainly happened during these time frames, and we haven't seen this kind of a divergence in this relationship in a long time. There's an interesting period back here in 2008 where you'll see the carry trade got strong and the equities were getting weak, which may have indicated something was wrong with this, but when the carry trade started to fall apart, the whole market really careened lower. So even there, it was a pretty good indication that when the carry trade started to fall apart, the equity markets fell apart as well. At this point, had the equity markets turned higher and the carry trade continued higher, that would have been a good indication that the equities were wrong. Right? They were going in the wrong direction. But as it turns out, it wasn't. They started going in the same direction and smash. So how would I look at this right now? Well, the symbol DBV in terms of an ETF, if this is wrong, then it's got to start moving back higher. If the equities start turning lower and this continues lower, then this divergence was a huge heads up well in advance. All right, now we haven't missed it. Remember, this part of the presentation has to do with if the markets turn lower, do you want to be a buyer or do you want to sit back and wait for the bottom to be put in, or take a more aggressive position and get short. So for what it's worth, keep your eye on it. I think it's pretty interesting. For the equities standpoint, hope that the carry trade turns around and starts to rally. But if it doesn't and moves lower and the SPYs move lower, I will take it as a pretty severe warning of the weakness that could ensue. All right, so there's one other chart similar to that is new here. Haven't shown this relationship in quite some time, but it's the same idea. And this one takes a look at the SPYs relative to the high yield corporate bonds, all right, the HYGs. Now the same idea. These two markets are pretty well correlated. It looks like a mess, but for all intents and purposes, when the HYGs are moving up and making new highs, then the SPYs should be too. Or I prefer to look at the other way around, which is if the SPYs are moving up and making new highs relative to prior highs, then the HYGs should too. And if they are, then everything's in sync. But what we have going on right now is a pretty significant divergence. Hold on, I had a yellow bubble here, but all right, it's not there. You can see it. Here's what I want to point out. Here's the last high in the SPYs. We've moved up since then. In the same period, you've got the HYGs, the brown line, moving down. A pretty significant divergence, and it's even more visible if you look at it from a weekly perspective. Okay, so weekly we moved up. Meanwhile, HYGs have gotten hit pretty hard. Now this has happened a couple times in the past, and sometimes it's easier to see on the daily versus the weekly. Let's take a look at the other place on the weekly where it's kind of blatant. Back here in late 2009, SPYs made a huge progress over the prior high. HYGs did not. When the HYGs turned down and the stocks turned down, it was an indication that this was pretty significant. If we take a look on a daily basis, again, HYGs are in the brown. They don't make a new high during the same basic period that the SPYs are climbing. When they both start turning down, watch out. And in this case, it was kind of a watch out. We move lower when the markets move, try to make a new high, and then they both turn down again. Again, watch out. All right, this is all. I'm not saying it's going to happen tomorrow. In fact, all we have to do is watch the price. And if the price starts to turn down, then these indicators are saying this is a good time to be cautious. Again, here's the situation I showed you on the weekly. In 2010, SPYs make new highs going into April, but HYGs are unable to. When they both turn down, it indicates something's not right. If we go all the way back to middle of 2007, you can see HYGs absolutely falling apart as stocks are trying to grind higher. When stocks finally give up, it gets pretty ugly. And that's what we want to avoid. We just want to know, again, whether this is a good time to be looking to buy that weakness or let the weakness play out If we see weakness in the coming weeks, I'm saying let it play out. All right, that's it for this week. Hope that's interesting. Hope that helps. And if you're in one of our services, Mish's Market Minute Premium for swing traders, or the Opening Range Success Formula and Day Trading Mastery Program for day traders, we'll see you in those services during the week, giving you updates to indicators like this and trade ideas. If not, I'll see you next week in the Market Outlook. Have a great week.